Joining us right now is Mahoney Asset Management CEO Ken Mahoney. Ken, it's good to see you.
Good to see you.
A lot of things that the markets are digesting. You've got the potential of a China deal. We're in the doorstep of third quarter earnings. Of course, you've got a Fed meeting coming up in 2 weeks. Tell me first how you see things.
Yeah, we're somewhere in the twilight zone. We've been kind of liking this market with the volatility. I'm making volatility our friend. Buying the dip last week, we're deeply oversold. Very close after today's open. We'll probably be overbought again. The pendulum swings so quickly with sentiment. So again, we were buyers on dips last week, and we probably would sell into this rally. Specifically, again, we were buying back technology. We definitely like technology here. Large cap tech. We think money flows back there once we resolve this thing. And you know, the under and over in this thing is very interesting to see how this is all going to play out today. That's for sure.
Nancy, how do you see it?
Yeah, I mean, listen, I'm in the same camp, except that my time horizon might be just a little bit longer. You look back, and we've got trailing 2-year return of almost 20%, right, for the S&P, and 7.5 for the 1 year. What do you think about in terms of total valuation?
Yeah, I mean, it's so funny. The Bears had everything to work with here. They have all the headlines. It's like that Billy Joel song. We didn't start a fire. You know, Russia, China, Turkey on the move. You know, this craziness, and you know they get it for like three downs and have to punt it. And the Bulls haven't done much with it either. But the headlines, the Bears, so there's the persistent bid that's here. And I think that's because of stock buybacks. I think we have low interest rates. We keep forgetting about that. The 10-year at 165, 167
a lot of cash
offers low competition to stocks, and you still have performance anxiety. I mean, look, come on, the market's still 15% year to date. A lot of money managers are still underperforming that level and had to put money to work also. So you have this persistent bid, even all these negative headlines, and the Bears really can't do much with it.
Well, Dagan, I mean, you got the Fed expected to cut rates, what, 70% chance that the Fed cuts rate in 2 weeks, October 30th.
Well, we were taking a look at the 10-year Treasury, so it's still below 1.7%, and that's why they will cut, because you still have short, very overnight lending rates higher than the 10-year Treasury yield, and it just fouls up the banking system. Banks struggle to make money from lending when you've got an inversion like that.
And the longer this goes on, the tougher it will be for the financial services industry. You know that, the banks. What about earnings season? Are we going to see that in the earnings that we're going to get in the next 2 weeks? I mean, next week the earnings period begins.
Yeah, I mean,
and then the following week we get all the banks.
Exactly. I mean, we're literally in the twilight zone here today, right? Because last week was the Fed cutting rates. Here we are with China, and next week, right into earnings. Yeah, the banks are up first. Again, I'm more of technology. We tend to like more of the technology. I think the banks will do the very little surprises at the banks for the upside or the downside. Look, every cycle is going to have their winners and losers, their surprises. But again, if we're going to get out of this kind of trading range, if we get some better guidance, maybe that can get us going again. But at this
look
point,
at all the names coming out next week. JP Morgan, Citi, Bank of America. You got Netflix as well, and Morgan Stanley. Meanwhile, the private market, a couple of disasters I want to get your take on, Omi. Mutual funds that invested in companies like Uber, WeWork, Lyft, suffering big losses, forced to mark down holdings in the unicorn companies once they're darlings of the financial world. Omi, this is your business, the private market. What's your reaction to some of these blow-ups in the private market?
Probably not to surprise you. I'm going to be a bit contrarian. I actually don't think it's nearly as bad as people are making it out to be. So, as we've spoken about before, what's ending up happening now is the mutual funds and the hedge funds that used to prop up IPOs on day one are not there anymore. They're actually buying these names 2-3 years earlier. So if you look at when they've purchased these names, it doesn't matter that the stock's taken at
such a low
15% level because they've already made all of their money. So the secondary market that we work in the private market is there. There's liquidity, and people are making actually a lot of money. We just have syndicate desks acting in the private market the way they used to in the public. So unfortunately, that means that the retail buyer is actually the one that's going to be hurt when they buy it in the IPO. So we have a restructuring of capital markets going on.
So retail buyers know by watching these IPOs, I'm not stepping in on day one. Individuals are smart, and where does that leave the investment banks that are supposed to price these stocks appropriately so they don't fall off a cliff in the first days of trading?
Well, I'm about to get a lot more competition in my business because that's where they're getting all the fees now, is they're doing the exact same type of offerings. They're just doing it in the private market. So we're going to have to see whether we're going to allow retail investors potentially to start buying into the private market, but that ends up having a whole host of other regulatory issues that you don't want to get into that we've spoken about
That's
earlier.
A slippery slope.
Slippery slope, absolutely.
You need to be a credit investor to begin with. So
Precisely.
That's where the issue is at this point.
And that helps productivity and growth.
And really, what's that fine line between having access to that, where most institutions have access to, but yet being a credit investor, and that's where the issue is.
Exactly.
All right, Ken, it's great to see you.
Good to see you.
Thanks so much. Ken Mahoney joining us there.